Everyone has been asking me, what do I think is going to happen with interest rates rising and how it's going to affect our housing market, and if interest rates are going to continue rising or if they're going to fall back down. And while I don't have a crystal ball, interest rates are definitely on everyone's mind. So I'm going to do my best to give you some insight and some things that I think about when we look at interest rates. I'm ready. Let's go. All right, so the first thing that I pay attention to when we're talking about interest rates is actually the United States 10-year Treasury bond. The reason for this is if you look back over the last 50 years, the mortgage interest rates have always moved in unison with the 10-year Treasury bond. So it's not in perfect sync, but it's definitely in unison. So I'll show you the graph here, but you can see as Treasury rates begin to rise, so do mortgage rates. It's a long, complicated answer why that happens. I'll even put a link below if you're curious to dive deeper into that. But the main thing to remember is that the mortgage rates do go in line with the 10-year Treasury bond. The second thing that we look at when we're looking at mortgage interest rates is how that affects the buyer in terms of the payment, because there's a whole psychological factor of, buyers wanting the interest rate to start with the number 3, and now the interest rates are starting with the number 4. So in part, it's psychological that we have that hurdle to get over. But when you look at the nuts and bolts of how it actually affects your payment, then that's where it really gets interesting and starts to affect the market. So let's look at this graph here. This is how we know things are going to change. Now, I will say, I'm not trying to predict any big market crash or anything like that. I'm just simply pointing out the true numbers of how the interest rates affect your monthly payment. So, if you were a buyer, or you are a buyer, and you want your house payment to be $4,000 a month, and you were looking at putting, this is based on putting 10% down and I'm talking numbers in principal and interest only. So property taxes and mortgage insurance is extra, but just principal and interest only. If you wanted that number to be $4,000 a month, if the interest rates were 3%, which they were not too long ago, then that means you could buy a house at $1,054,444. So $1,054,000 is your purchase ability based on 3% down. So what happens if interest rates jump to 4%, which they recently did and have now surpassed? If you still want that same $4,000 a month payment, now you can only buy a house for $931,000 instead of the $1,054,000. And so you can see there's a variety of factors why the housing has gone up so much in value, but a big driver of this was the interest rates. So if the lender calls you and says, hey, you can actually spend another $100,000 and still have the exact same mortgage payment, buyers, quite frankly, were doing that. So now that the interest rates have changed, I think it's going to affect some buyers, not all buyers. There's still a lot of cash in the market, which they'll be unaffected by the interest rates or minimally affected by the interest rates. But for your average middle class working families, this is going to have a big impact. So just to continue on that $4,000 a month example, if interest rates jump to 5%, which we're not there yet, but if they do get there, you can now only afford $827,000 home price, as opposed to, again, the $931,000 if it's 4% and the $1,054,000 if it's only 3%. So interest rates do have a big effect. I hope the explanation on how that affects your payment is helpful. And the last thing I will mention is that just keep in mind, real estate is a slow-moving cruise ship. It takes a while for the thing to turn around. So even though interest rates have risen, we are nowhere near any kind of crash, mainly because the inventory is still so incredibly low. There's just not enough homes to go around for all the buyers. In fact, I will show you one final thing before we end this video, which is our active inventory. So you can see on this chart here just how low our inventory is. Normal in Orange County is about 6,000 to 8,000 homes on the market, which you can see on this purple line. Back in 2019, we did have that kind of inventory for a while. But then 2020, we dropped to about 4,000 homes on the market. Then 2021, we dropped to about 2,000 homes on the market. And today we're less than less than 2,000 homes on the market. You see it right here on the graph, but it is crazy low inventory. There's just not enough homes. So when there's so few homes available, even with the interest rates rising, even if half the buyer pool dips out of the market, which they may, you would then have, let's say, 7 or 8 offers on every property, as opposed to the current rate, which is about 10 to 15 offers on every property. So it's just a wild market. I hope the video is helpful. If you want to talk more about interest rates, how it affects you personally, I'm always just a phone call away. Thank you guys for watching the video, and make sure you subscribe. And one final ask, if you have a question about the real estate market and you want to know my honest opinion, where do I think things are heading, how would I play it in your situation, I love the questions because it gives me good content for my YouTube. So keep in touch with me, let me know what questions I can answer for you guys, and talk to you soon.